Welcome to KPMG's accounting update on ASU 2016-15. Today we will provide some background and an overview of the key changes on 8 cash flow classification issues addressed by the ASU. My name is Vicki Pollack and I'm a senior manager in KPMG's Department of Professional Practice. This project was initiated based on feedback the FASB received indicating diversity in practice in the application of Topic 230. In 2014, there were approximately 168 public restatements related to the statement of cash flow issues. This was the second source of restatements for public companies after debt and equity. The EITF was tasked with resolving 9 statement of cash flow issues based on the existing requirements and guidance of Topic 230 to reduce diversity in practice on a timely basis. One of the 9 issues related to restricted cash required more investigation and was removed from Issue 15F and is now EITF 16A. The board completed its project on the other 8 cash flow classification issues in August and issued ASU 2016-15. We'll talk about the 8 issues addressed in the ASU on the next couple of slides. For issue number 1, the ASU requires entities to classify debt prepayment or extinguishment costs as cash outflows for financing activities. For issue 2, the settlement of zero coupon bonds or bonds issued at a discount with insignificant cash coupon, the ASU states that at settlement, the portion of the payment attributable to the accreted interest should be classified as a cash outflow from operating activities, and the portion of the payment attributable to the principal should be classified as a cash outflow from financing activities. For issue 3, regarding contingent consideration payments not made soon after the acquisition date of a business combination, classify the portion paid up to the amount of the contingent consideration liability that was recognized at the acquisition date fair value, including measurement period adjustments, as financing activities, and classify any excess as operating activities. As a reminder, cash payments made at or soon after the acquisition date of a business combination to settle a contingent consideration liability should be classified as cash outflows for investing activities. For issue 4, proceeds from the settlement of insurance claims should be classified based on the related insurance coverage. So, in other words, based on the nature of the loss. For insurance proceeds received in a lump sum settlement, an entity should determine classification based on the nature of each loss included in the settlement. For issue 5, cash proceeds received from the settlement of corporate-owned life insurance policies, including bank-owned life insurance policies, should be classified as cash inflows from investing activities. Cash payments for premiums paid may be classified as cash outflows for investing activities, operating activities, or a combination of investing and operating. The ASU permits but doesn't require alignment of the classification of premiums with the proceeds received. For issue 6, the ASU requires entities to make an accounting policy election to classify distributions received from equity method investees using either a cumulative earnings approach or a nature of the distributions approach. Under the cumulative earnings approach, distributions received are considered returns on investment and classified as operating inflows. But if the investor's cumulative distributions, less distributions in prior years that were determined to be returns of investment, exceed cumulative equity and earnings, the current period distribution up to this excess is considered a return of investment and classified as investing inflows. Under the nature of the distributions approach, distributions are classified based on the nature of the activities of the investee that generated the distribution, as either a return on investment, which would be a cash inflow from operating activities, or a return of investment, which would be a cash inflow from investing activities. For issue 7, a transferor's beneficial interest obtained in a securitization of financial assets should be disclosed as a non-cash activity, and cash receipts from payments on a transferor's beneficial interest in securitized trade receivables should be classified as cash inflows from investing activities. Finally, for issue 8, the ASU includes new language to help entities understand how the predominance principle should be applied, including when identifiable cash flows should be separated. Entities should classify cash receipts and payments that have aspects of more than one class of cash flows, first by applying specific guidance in U.S. GAAP. In absence of specific guidance, entities should classify each separately identifiable cash source or use on the basis of their nature in financing, investing, or operating activities. Cash flows with aspects of more than one class should be classified based on the activity that is likely to be the predominant source or use of the cash flows. In terms of transition, the amendment should be applied retrospectively to all periods presented. If it's impracticable for some of the amendments to be applied retrospectively, then those amendments should be applied prospectively as of the earliest date practicable. If retrospective application to all prior periods is impracticable, then the entity would provide a disclosure of the reasons and a description of the alternative method used to report the change in accounting principle. In terms of effective dates, as we show on the table on this slide, for public business entities, the ASU is effective for annual and interim periods beginning after December 15, 2017. For all other entities, the ASU is effective for annual periods beginning after December 15, 2018, and interim periods in fiscal years beginning after December 15, 2019. Early adoption is permitted, including during an interim period, but it's important to remember that all amendments must be adopted at the same time under the retrospective transition method. Thank you for listening to today's accounting update on ASU 2016-15.